Hi everyone, welcome to Bharat Alternates. I am very delighted to host all of our audience today and welcome you on the today's session on ICICI PMS Quant Investment Framework. And to guide us through this exciting world of data-driven investing, we have with us someone who is very special, Mr. Sandip Santdasani, who is the CFA. So, just giving a little brief about Sandeep. So, Sandeep brings years of experience in the capital markets and the portfolio management space and AIF space. And what makes him stand out today is his ability to simplify the complex markets. He has been at the forefront of building quant strategies that combine power with numbers with real world investing, helping high net worth individual, ultra high net worth individuals, and NRIs navigate the markets with confidence. And what I personally admire about Sandeep, it was just a random conversation in Delhi, which helped me connect with him today. He just not look at the markets. He also put himself in the shoes of investors. So people like all of us who want to grow and protect our wealth for the long term, Sandeep is there, to help us. So welcome, Sandeep. I think you have completed more than 17 years with ICICI Asset Management Company now. So welcome, Sandeep. Happy to host you and a warm welcome. We are excited to hear your thoughts.
Thanks, Gitansh, and thanks a lot for giving us this opportunity. So happy to connect with your investors through this platform. Hope we will have a very interesting conversation.
Look forward, Sandeep. So topic of today's webinar is Quant Investment Framework, especially on the alternatives side that you manage, the AIF that you manage. So today we'll be talking about the strategies that you manage. Maybe we can take over the smart strategy. So let's start with simple questions so that our audience can understand. So what are the key drivers that you think, drivers of the market? And among the key drivers, what do you think are some of the important drivers of the market?
No, I think it's a very interesting question because from a longer term perspective, if you see what drives the market, the fundamentals drive the market from a longer term perspective. In short term, when you see 1 day, 1 week, 1 month, maybe sentiments are playing a role. But when you see 1 year, 2 year, 3 year, more longer you go, fundamentals actually play a very important role. When you see last 10 year, 15 year, 20 year, 25 year history, you will see that there is a very strong correlation of market with the earning numbers which the companies have delivered over a 15, 20 year, 25 year period. And that way earnings have a very strong correlation with the economy. So economy drives the earning number for the companies, and earning numbers over a longer period of time drives the market return. So I think these are the two main important factors which will decide what kind of return investors will make over a period of time.
Got it. So now coming on to the topic which we have for today's webinar, which is Quant Investment Framework. But before moving on to the Quant Investment Framework, let's understand from you, like what is quant investing? And so just a basic about quant investing.
No, so let's say if I give you a comparison with how a fundamental driven portfolios are managed and how quant driven portfolios are managed, and how they have a similarity and how they are different compared to each other. So when you see any portfolio manager who wants to generate alpha from a longer term perspective, as I said, in longer period of time, the market is the return of the markets are derivative of the earning numbers which companies have delivered, and the earning numbers are derivative of how the economy has done. But obviously, everything will not move in a very linear fashion, and there will be periods when the economy will go through tough times, and in those periods, different kind of sectors will do well, and there will be periods when the economy is doing extremely well, and in that period, different kind of sector benefits. Much more. So that way, any portfolio manager who wants to generate the alpha, they will go overweight on a particular sector basis the macroeconomic situation of the country from a top down perspective, which are the sectors which can benefit in that kind of macroeconomic situation. The portfolio manager takes that call. Now when you see quant way of investing is where when you on one side there are sectors which is in a way a place where a portfolio manager will go overweight underweight. On other side, on quant investing, it's a factor, right? So there are various different factors, maybe low volatility or value or growth or momentum. There are various different factors basis which you can create the portfolio, And again, these factors also are in a way benefits, like sector benefits from a macroeconomic situation, same way factors also benefit from a macroeconomic situation. So when you want to create a portfolio basis one factor two factor, you have to see what kind of macroeconomic situation we are into, and you can actually go overweight on that particular factor. And maybe over a period of time, that is quant way of investing, I would say. So that way factors are very important. And what are factors? So it's a common ingredients. The sector will be comprising of similar kind of companies in operating in a same industry. Same way when you see factors, now when you say factor, you will find lot of companies in the in that universe will have a similar kind of characteristic. I'll give you very simple example, very basic, but value is one factor. Now, in value factor, when you see, you will find a lot of companies across sectors. But what would be the common characteristics in all those companies? They all will be trading at a reasonable valuation compared to the rest of the universe in the particular sector. And that way, the common characteristic in those companies would be value. Valuation would be lower compared to rest of the peers in the respective sector. So this is how quant works, and in a way you are trying to identify companies basis various different factors, and you try to create a portfolio which is going to do well from a longer term perspective. So that's how there is in a way similarity, but this is how they are different compared to each other.
So don't you think from investors' point of view, I am thinking that factor performance also sometimes can appear to be cyclical in nature. So how do you decide when to overweight or underweight with specific factors like value, momentum, quality? How do you think that?
No, I agree. It's a very interesting point, and why it is in a way when you want to outperform. Again, I will give you some similar comparisons with a fundamental based investing. Now, when you want to create a portfolio sector fund, if your call plays out well, the sector fund will give you maximum return, right? But obviously, the volatility of that investment will also be very high, right? So, same way when you want to create a portfolio of single factor, now again the volatility will be very high. If you can time it well, probably the alpha can be substantial, but timing a particular sector is very difficult. Same way timing a particular factor is also very difficult, and that's the reason what is the solution. You can create a multi-factor portfolio. So you are not trying to create a portfolio which is a single factor, but in a way you are trying to use multi-factor so that volatility of that portfolio will be lower compared to a single factor driven portfolio. Now, single factor driven portfolio actually can do extremely well if your call plays out well. But there are patches, there will be patches even in times to come where the a single factor will. There was a period in between 2018-19, if I'm not wrong, was a period when value factor actually was struggling. But post 2020, 2021, value factor had done extremely well. So let's say if you have a portfolio which is tilted on single factor, then probably it will go through those kind of patches. If you want to reduce that kind of patches for your portfolio or for your investors, then the solution is to opt for multi-factor so that you are not timing a macroeconomic situation. You are not trying to take a call on a single factor.
Got it.
So
So
the solution is multi-factor. I think multi-factor funds have done well over a last 15-20 year period, and hopefully in times to come also they'll do well compared to a single factor driven strategies.
got it. So I think you have already answered the couple of questions that I had in my mind. So primarily you are saying that multi-factor model is something which is supreme to a single factor model, right? If we talk about the advantages and disadvantages of both these models, if you can tell us.
No, as I said, if your call plays out well on a single factor, it can actually deliver a higher return compared to multi-factor. But again, timing a factor is similarly timing a sector is difficult. Same way, timing a factor is also difficult. Now, why it is difficult? Because you have to actually take a call on macroeconomic situation, and taking a call on interest rate, taking a call on inflation, taking a call on fiscal situation of a country. It becomes very, very difficult, both from an entry perspective and exit perspective also. So that way, compared to a single factor, from a risk adjusted point of view, multi-factor can be a strategy which can give you lower volatility from a longer term perspective.
All right, got it. So also, if you can give us, ICICI Prudential Alternates Quant Framework, is if you can, take us into deep insights what exactly is followed in ICICI Quant Framework, and also how it is different from the traditional PMS that are managed, you can say through gut feeling or through fundamental investing, how it is different.
So I'll try to highlight how it works for us and how we are trying to use quant in our investment framework, how we believe it is helping us from a stock selection perspective. Now we have very well defined investment framework, which is based on three parameters, which is business, management, and valuation, which we follow on the fundamental side. So we like businesses which are growing faster than the sector. We like sectors which are doing well compared to the overall economy. We like managements which are taking right capital allocation calls, and we want to buy these businesses at a reasonable valuation. So business management and valuation is a very well defined framework which we are using on the fundamental side. Now, how we are trying to use quant in this, and we are trying to have an overlay of quant on this framework. We are trying to actually use quant, use different factors to eliminate companies, right? So when you want to create a portfolio of, let's say, 35, 40 companies, then what is more important that you actually weed out with what kind of companies you don't want, right? So basis factors we try to eliminate first. So if
Okay.
I give numbers, internally we are covering around 600 plus companies. And what we do, we use five different factors to eliminate, and we try to bring it down to almost 150 to 200 companies. So that we almost 70% of the universe we try to eliminate through factors, right? So there is very interesting saying in one of the interesting book which I had read, which highlighted that if you try to eliminate, if you want to build a portfolio of companies, if you try to use elimination framework, it works very well, right? So in a way, you are trying to eliminate first and trying to find or create a portfolio out of the universe which is left after the elimination framework. So we are using factors to eliminate, and we come out with a smaller universe, and then the framework of business management and valuation is applied on that smaller universe, and a portfolio is created out of it. So that way it is a combination of fundamental and quant. So fundamental investing with a quant guardrail is what we are trying to do in smart fund.
Got it. I think Charlie Munger also says it always invert. So you start from the end and then you come at a universe. I think that would be the principle here. So
Right.
also, if you can take us deep inside the strategy that you manage in your alternative investment fund with this smart strategy, if you can share what you are exactly doing, what is the current allocation, that would be really helpful for our investors.
Sure. So how it works, as I said, we are applying the elimination framework first. So we are covering around 620 companies internally, and there are five factors which we use to first eliminate. So the first factor which we are using is low wall. So again, here the the purpose of using low wall is not to identify companies where the volatility is low, but we are using low wall factor to eliminate high wall names, right? So out of 600 companies which we are covering, we are trying to remove first high wall names out of the universe. That works very well because in a way, a lot of companies where the perception of corporate governance standard is poor, a lot of time you would have observed that those companies have a higher stock price volatility. So in a way, eliminate companies where the volatility is very high. The second parameter which we are using is valuation. And again, valuation is very important. We are not trying to find the cheapest values which are available in the universe, but we are trying to eliminate the expensive one. So again, the approach is not to buy cheap value companies, but avoid the companies where the valuations are very expensive. The third factor is quality. Again, here we are trying to identify companies where the quality is deteriorating. So again, eliminating the companies where ROE, ROA, ROIC, those factors which are in a way framework to identify quality companies, if they are deteriorating, we are trying to avoid those companies. The fourth factor is earning growth. Again, we are trying to see where the earning growth is in a way lower compared to the universe which is left. So eliminating the companies where the earning growth is not very strong. And the last factor is price momentum. After the four factor which are more fundamental driven, we are trying to use price momentum to identify companies which have a positive price momentum that way. So that way, these are the five factors which we are trying to use on this 620 companies which is under coverage. And after elimination, we are left with around 180 to 200 companies. And the fundamental approach of business management and valuation is then applied to this 180 to 200 companies, and the portfolio is created out of it. Now we have done back testing, and it has actually done the outcome of that back testing was very strong. Even the even the equal weight portfolio of top 100 companies or even top 250 companies would have generated sizable alpha compared to the compared to the benchmark. So that way, we believe that this combination of fundamental plus quant investing or using data in an efficient way will help us to do well over a longer period of time.
All right, great. And also, there is one more question that I am having in my mind, that how does your smart framework that you have, the quant framework, how do you pick like which sector to, or sorry, which I would say, where are the opportunities like in large cap, mid cap, small cap? So how do you find that?
No, so as I said, when we apply this framework on 620 companies, this 620 companies is combination of all segments of the market, large cap, mid cap, small cap, across sector. So that way, when you construct the portfolio, it is in a, even when you see the universe which is left after the elimination, 180 to 200 companies have a combination of large cap, mid cap, small cap, all segments of the market. Now you then take a call from a fundamental standpoint that which part of the market you want to go overweight, or you can actually take a very bottom up approach also of identifying businesses rather than focusing on market cap. So that's the approach which we follow even otherwise also in our fundamental way of investing. All the portfolios are more bottom up and not trying to have a starting point that we want to keep this much large cap, this much mid and small cap. So that way it's more of a outcome, I would say, not a input. And as of now the portfolio has around 60% into large cap and remaining 40% into mid and small cap. So it has combination of both large caps and mid and small cap, and it is more of outcome, I would say, not a starting point as an input that we want to keep 60% large cap. So
So
it's
going
a
forward,
in a way portfolio which is sector agnostic, market cap agnostic. As of now, has around 60% large cap and 40% mid and small cap.
so going forward, the allocations can change also, right? If
It
you
can change. It can change depending upon which part of the market is offering better opportunities. It can change.
got it. And a lot of new age companies are coming, a lot of IPOs are coming. If we read Economic Times, like first 4 5 pages are of the new IPOs.
Right.
So does your quant framework also takes into consideration the new IPOs that are coming in or the new companies that are listed?
So there are two parts to it. When we see from a quant standpoint, it's more data driven, right? And
Okay.
data obviously will be available for companies which have a track record after listing. So that way, a lot of companies where the track record is less than 3 years, because the track record is not very long, those kind of companies actually are where quant framework is not trying to focus much on. Second thing, from a fundamental standpoint, the framework of business management and valuation remains same. So that way, if companies are offering a high growth opportunities and where the managements are taking right capital allocation decision and valuations are not very expensive, in that case, those kind of companies we are very open to have in our portfolio. But again, it has to go through all the filters, and there is no exception for even new age companies that way.
Got it. And just talking about the core principles that you behind your risk-adjusted returns that you are trying to generate for the clients, and especially on the portfolio construction side. So how do you manage the performance as well as risk management both hand in hand? How do you do that?
Okay, so managing performance obviously is not what we target, because ultimately it's a outcome. You cannot manage outcomes. You have to focus more on inputs. Now,
Right.
in inputs, actually, what we are trying to do, we are trying to have combination of companies where we get combination of business management and valuation, all three. Companies where the growth is stronger, companies where the ROE, ROICs have an improving trend, and along with that, aim is to buy them at a reasonable valuation. So that's the input which we are very focused on, not trying to in a way focus on output, because that's not in your hand as a fund manager or as an investment team. Now, the second part is on the risk management side. Now, when you see risk, it's very interesting because there is difference between risk and volatility. Risk is where your stock price falls and never comes back. Volatility is where the stock price will fall and will come back. Now, the point is, risk is more of a permanent loss of capital. Volatility is more of a temporary loss of capital. The more you focus on how you can reduce the volatility of the portfolio, in a way, you will become more cautious. In a way, you can have more companies in the portfolio. And that way, maybe you are, in a way, your return might be lower compared to a concentrated portfolio. So that way we believe 35 to 40 number is a balance between a concentration versus very diversified portfolio. We are trying to have companies which is having around 35 to 40, but our focus is more on how we can minimize risk part of the portfolio. Now, what is risk? Where you lose capital permanently. And normally that is the case when you identify a business where the fundamentals are deteriorating. Those kind of companies is where there is a potential that the businesses might not deliver a return from a longer term perspective also. The second is where you are investing into managements which have a very poor corporate governance track record. So those kind of things we are trying to avoid by having a framework which is based on business management and valuation. But in a way, we are okay to have volatility in the portfolio, specifically in alternate side, where the portfolios are more concentrated, where the portfolios have high active share, they are different compared to the benchmark. That way, the point is that these portfolios have potential to deliver alpha, but in a shorter period of time, actually, they will be more volatile compared to the broader market. So we are okay to have volatility, but the focus is how we can minimize risk part of it. And if we can do that consistently over a period of time, your risk adjusted return looks reasonably well placed.
Right, right. And just one more question that is running in my mind on the quant side. So, is there a human overlay or it's purely systematic? Your quant strategies are purely systematic, or is there a human overlay also involved? Which I must believe that there must be some human overlay because, a lot of team is required. You have a big team in the research side. So maybe if you can give some emphasis on this question.
No, so I think when you have both resources available, on one side you have quant framework, you have data, you have a lot of systems, you have people who are managing those data and framework and algorithms. But on the side, you have a very large equity research base also. So we believe why not to combine both? Why to compete with each other? Why not to combine both and how it can benefit the investor is what we believe, and that's the reason we are trying to use overlay of fundamentals also in our quant investment framework. So as I said, we are trying to eliminate first, trying to get a concise universe after that elimination, and over and above that, a fundamental portfolio manager is building the portfolio. So that way, it's combination of quant and fundamentals. It is not quant versus fundamentals. We are of the opinion that it is quant plus fundamental, which will play a very important role over a period of time. So there are two ways of investing, which is combination of both. One is where your fundamental investing has a quant guardrail, and the second is where the quant investing has a fundamental guardrail. So I think we are of the opinion that it is quant plus fundamental, not quant versus fundamentals.
Got it. Got it. And just one thing that how are because see the markets have already I would say a bull run after the COVID recovery markets has been one way. All the stocks, especially the stocks, if we talk about large caps also, they have done well, mid and small caps have done well. So right now we see that the valuations pretty seem little high. So how do you see how are you protecting downside if any major turmoil comes into the market? So how is your strategy, your framework defined to protect the downside in the investor's portfolio?
No, so as I said, when you take a view of constructing a portfolio from a longer term perspective, so what is important when you want to invest into equity market? First of all, time horizon is the most important thing. So
Mhm.
when we try to construct the portfolio, at least we have a 4 to 5 year kind of time horizon, and so that way we are trying to build the portfolio from a 4 to 5 year perspective. Second thing, as I said, what you want combination of growth Second is the competency of management. Third thing, you want reasonable valuation. So that is the combination which we are aiming for. From a longer term perspective, it ensures that the portfolio do well. Obviously, there will be patches in between when the portfolios will have drawdown, but I think from a longer term perspective, this kind of combination will help portfolios to do well. The third thing is that when you want to focus more on volatility, in a way, the portfolios will have higher cash. The portfolios will have more number of companies. So that is what we are trying to communicate to our investors also, that PMS portfolio specifically or AIF portfolio specifically will be more concentrated. They will be more different compared to the benchmark. It will have higher volatility compared to the broader market in periods in between. But from a longer term perspective, if your call goes more right than wrong, or if you are making more money where you are going right compared to losing money where you are going wrong,
Right.
that's you will create the alpha from a longer term perspective. So that is what we are trying to do in PMS and EF investing at ICICI Prudential AMC.
Got it. And there can be some scenarios where short-term trends look very attractive. Like there can be some sectors where, for example, say infra or some sector which looks attractive in a shorter term, say 2 years, 3 years, but that sector is also cyclical in nature. So how
Right.
do you identify the short-term trends your portfolio is aligned to make the short-term changes, or are you willing to hold a stock for 3, 5 years? I mean, you can also throw some light on the churn in the portfolio that is happening right now in your smart strategy, smart PMS.
So we are in a way capitalizing the short term opportunities also. When you said 2 year, 3 year, obviously when you invest in any particular company, the view is at least to have a 2 to 3 year kind of time frame when you invest into particular company. So that way the portfolio is trying to find opportunities both in short term. By short term, I don't mean 1 week, 1 month, 3 month kind of scenario, but at least 2 to 3 year kind of view. If you have a particular company or sector, we are very comfortable to have that kind of framework. And then the portfolios are monitored or managed very actively. So if any company which we have bought, and if it delivers return in a very short period of time or faster than what we had anticipated, in that case we try to reduce exposure into those companies, even if it is in short term period. And otherwise the approach is to hold the company for at least 2 to 3 year period in the portfolio. So that way when you compare our actively managed portfolio, they have a lot of companies where we are holding those companies for more than 3 years, more than 5 years also. And there are names where we bought the names and they have done very well in a shorter period of time. We were okay to book the gains even if they were in shorter period of time. So that way it's combination of both. There are names where we are holding it for long, and there are names where it is combination of short term and long term both.
So basically, you are trying to do both things, long term plus taking the advantage of
Correct.
short term trends as well, right? So now the question that I have is right now in India, there are more than 400 PMSs. Some are boutique funds, some are bigger firms, and approximately 200 AIFs that we have on table today. So
Correct.
what makes ICICI Smart Strategy, Smart PMS different from other products that are existing in the industry?
No, as I said, because here it is combination of quant and fundamental. I think it's first in a way benefiting from both. One, on the data side, you are in a way trying to find the trends which are changing slightly faster way. So that is the big advantage when you combine fundamental with quant. The second thing is that why iPro and why. So there are two questions, right? One is why iPro, and second is why quant plus fundamentals. Why approve? The big advantage which we have is 600 companies which we are covering. The research team, which is almost around 23, 24 member team, and they are covering around the 620 companies under coverage. I think the large universe which we have under coverage is the very big advantage, and that is what we are trying to leverage on. So being a part of larger ecosystem, being a part of ICICI Prudential asset management company as an institution helps us to cover these many companies, take advantage of the larger team which we have. So that is one thing which is in a way a very, very big advantage compared to a lot of peers. The second thing is smart. Now smart actually is trying to take advantage of both data availability, also systems, algorithms which we have tried to build over a period of time, along with the large team which we have. And that's the reason we believe this combination of both active management, active fund management, along with data is helping us to deliver in terms of experience which investors are looking for from a longer term perspective. So I think this combo is helping us, and we believe that's the reason this is a strategy which, in a way, investors should have a look when they are allocating into equities.
Got it. I think you have articulated it very well. So now just a last two, three questions, and then we will be ending the webinar. So it would be on general market. So what do you think that, any specific sectors, industries that you want to talk about that are expected to do well in next 3 to 5 years that you want to share?
So from a sectoral perspective, I think from here on, specifically the way markets have done in last 3 year, 5 year period, from here on it is going to be very company specific call which you have to take. So rather than focusing on a trend or a theme, we believe it is going to be very bottom up. Having said that, we like banking and financial services as a space. We have a few banks in the portfolio, which in a way are gaining market share from PSU space also. There are life insurance companies, asset management companies, wealth management companies. These are the pockets which are doing well, and they are expected to do well from a medium term to long term perspective also. The second pocket which we like is from cyclical sectors, from capex driven names. So in that we like industrials, we like few auto ancillary companies. So the we like cap goods, we like few construction name, we like few cement companies. So that way, that's another pocket which we prefer. On consumption side, our preference is more on consumer services. We are less on FMCG, but more on consumer services at this point in time, more positive on consumer services, because the discretionary consumption which is picking up in our country, that's where the tailwind will continue for long, and that's the reason we are more positive on consumer services and less on FMCG at this point in time. So these are the few pockets which we like. But again, I would try to put a disclaimer here that these are the names or these are the pockets which we like today, but maybe over a period of time it will change depending upon how macroeconomic situation, how valuations are evolving, and it's a dynamic world, so you cannot have a view which will not change. So it can change over a period of time, but these are the pockets which we like today, given the way markets are.
Got it. And what do you feel about the valuations of mid and small cap? I think this is the most asked question from a fund manager. What is the valuation of mid and small cap today?
No, I think 2024, start of 2024 was when we became slightly cautious on mid and small cap in terms of valuation. We are managing one of PMS strategy, which is investing into small caps and mid caps. That's where we had increased exit loads in Feb, March 2024. So that way, when we became cautious, we have, in a way, increased the exit load for those strategies which had higher exposure into mid and small cap. But I think when you say small caps and mid cap, it has to be very company specific call which you have to take, because ultimately, after 250 companies, everything is small cap. So that way, rather than taking a call on an entire segment, we are trying to take a company specific call. So that way, the approach is more bottom up here also in mid and small cap. Second thing, when you see last 3 year, 4 year trend, specifically after 2021, the earning growth also had been reasonably strong, specifically when we talk about small caps and even for mid caps. So that way, while the markets have done well, mid and small cap indexes have done well, but along with that, the earning growth rate also was stronger for these set of companies in mid and small cap space. So that way, from here on, obviously that kind of earning growth rate is not going to sustain. It is going to moderate. It is going to get aligned with the GDP growth rate,
Right.
and that's the reason, as I said, it has to be very company specific call which you have to take from here on, not only in mid and small cap but even in large cap, but more in mid and small cap, because that's where the universe is bigger and companies matter more compared to the overall segment, that way, specifically for PMS and AIF, where you have concentrated portfolios.
Got it. So I think you have articulated the entire webinar very well, Sandeep. you know, and all our participants today who is watching the video will get to know what do you exactly do in quant and what investment framework you follow. So I think it was very glad to host you. So thank you for being a part of our channel today.
Thanks, Gitansh, and thanks a lot everyone whosoever is watching the video. Thanks a lot for having me here on this platform. Thanks, Gitansh.
Thanks, thank you.